Hello everyone, good morning, good afternoon, good evening, depending upon when you are watching this video lecture. In the earlier sessions, we have completed the discussion on various computation of various variances, including material variances, labor variances, variable overhead and fixed overhead variances. And we have practiced some of these questions in the tasks given to you. But there were certain doubts related to some of the questions in those tasks. So let us quickly go through the recent task on standard costing that was given to you and the solutions for that task which were already forwarded. However, in certain areas, how the calculations have been done, there were certain doubts on that. Let us quickly go through them. So one by one, if we see question number 1 is a straightforward question. So I hope everybody would have done it correctly. If any mistakes computationally happened, you rectify them. So question number 1 and even 2 also are straightforward questions. Of course, in question number 2, we should know the basic information that 1 ton is equal to 1000 kgs. We cannot say I don't know that and all. We should know that. If not already known, know it now. 1 ton means 1000 kgs. 1 quintal means 100 kgs. These are some of the denotions of weights. So basic units of measurement, weights, liters, or weights and liquids, measurements, distances. Some common general knowledge is required, definitely, yes. Dozen means 12. These things are required. If suddenly question says a dozen, I don't know what is a dozen, we cannot say. So like that, there is nothing else in this question number 2. Only thing is to know that a ton is equal to 1000 kgs. Once it is known, we can compute all the variances related to materials. And question number 3 also is a straightforward question. If variances are given, different variances are given, we need to find out the missing item, that is the standard price of material B. That can be done by assuming it as X and substituting in the formulae related to each of these variances which are already given. So when there is only one missing number, there is no problem. Automatically, if you substitute it as if it is X, then the answers will emerge accordingly. For example, the first case says material cost variance is 170 rupees favorable. So what is material cost variance? That we should know first. What is material cost variance? That is SQSP minus AQAP. So SQSP for material A we know, AQAP for both we know. So AQAP is already known. That is 44 into 25, 66 into 5. So total is already known, that is 1430. That is known already. Then SQSP. SQSP here for material A we know, that is 60 into 20, that is 1200 plus 40x. So what does this mean here? Whichever formula of variance you are using, just take the SP of material B as X. Automatically the answer will emerge. So if we take this first example where material cost variance is 170 favorable, so 60 into 20, that is 1200 plus 40x, that is SQSP, minus of, already we know the AQAP. AQAP how much? 44 into 25, 66 into 5. That was 1430. So minus of 1430. That is equal to 170 favorable means positive 170. That's all. Then what is X? That has to be computed like this. For every case, you just have to assume SP is X and substitute in the formula. Then find out what is that X. So basically in this case, what will be X? So 1430 minus 1200. This side there is 230 minus, that goes to the other side, it becomes plus. So plus 170 divided by 40. That gives x to be 10. Same way if you do for all others also, you can find out the standard price for material B. Only one missing figure here. So each case is different case. So the same procedure if you follow, you will get 10, 15, 10, 15, 5 as the answer. In each of the cases, all that you need to do is definitely substitute in the formula. So we have SQ and AQ, but definitely one doubt comes, sir, what about RSQ? Yes, RSQ is what? Nothing but actual quantity in standard mix. So what was the actual quantity total here? What is the total of these two? Total of these two is 110. So 110 distributed in 6:4 means RSQ will be naturally 66 and 44. That's all. So we have RSQ also, SQ also, AQ also, AP also. Only one SP for one material is not known. Substitute in the formula, easily we can get that missing figure. That was question number 3. Then question number 4 has some more missing numbers. But again, one by one we have to break them. We cannot print the answer. Whenever there are missing numbers, we have to be very carefully putting the data in place for question number 4. So let us take question number 4. What was the answer here? What is available first of all? What is available? What was available is standard price is available 12.15. So first keep 12.15, 12.15 wherever standard price is available. That is first step naturally. Actual price is available 15 and 20. Keep it there. So 12.15, 12.15 wherever SP is there, 15.20 wherever AP is there, actual price is there. Standard input for material A is given, that is known, that is SQ, which is 50, and for material B we don't know that. Same way, actual input for material B is given, but A we don't know that. And then material price variance is not given, usage variance is not given, only for material B it was given, enough. So once whatever is there, we have to first catch that, what is available. So material usage variance for material B is how much? 300 adverse. So when there is usage variance, what does the formula of usage variance mean? It is SQSP minus AQSP. In other words, standard price into SQ minus AQ. That is usage variance, right? So when you already have that, that is what? So standard price minus multiplied with SQ minus AQ. That is usage variance, which is already known to us. So SQSP minus AQSP. That was the usage variance formula. But how much is the amount? That was given in the question. That was 300 adverse, it says. Okay. Let it be 300 adverse means minus 300. And for material B, what do we know? For material B, we don't know SQ, but we know AQ. And do we know SP for material B? Yes. So whatever you know, substitute first. Automatically you will get the answer. SP is 15 rupees for material B. SQ is what we don't know. So leave it like that. Minus AQ for material B, we know. That is how much? 70. That is equal to minus 300. So expand it. 15 SQ minus 70 into 15, 1050 is equal to minus 300. If 1050 goes to other side, then 15 into SQ is equal to 1050 minus 300. So naturally, SQ will be what? 750 by 15. That is 50. So that we got 50 rupees. Sorry, 50 units or kgs, whatever. Kgs we can say. So this one we got now already. So whatever was required. Standard quantity for material B, that we know 50. Then Actual quantity for material A we don't know. For material B we know. So with one variance which was given, we could break the standard quantity for material B, and actual quantity for material A we don't know. For that, yes, there is one more clue that is given. We have to use that. We cannot get the answer just like that. We have to use the information given, substitute, put pen on paper, then we get it. Most of the times in such questions, the big mistake people do is they want the answer in their brain. No, we are not that capable. First, we have to understand that. If somebody is able to do that, that is fantastic. But most of us are not that intelligent. That has to be first identified. We have to try, put the pen on paper. Number of times we have to try different options. Then we get the answer. I am not getting the answer. There's so many question marks are there. I don't know. I'm getting clueless. I'm getting afraid. Can't help it. That is not the way CA students work and CA course will work. You have to fight the challenge and then get the answers. So when one more information is given, maybe that is useful, but that is given for what? Material mix variance for both the materials together was given as 45 adverse. So that was material mix variance, which was given as material mix variance. So let us see what is the formula for material mix variance first. What is the formula for material mix variance? RSQSP minus AQSP. So that is the formula for material mix variance. In other words, standard price into RSQ minus AQ, that is equal to, how much is that? 45. But this is not for one. It is for both the materials we have to do this. So let us do one by one for each of the materials. What is the standard price here? Standard price for material A and B, do we know? Yes, we know that. Actual quantity for material B we know? Yes. Material A we don't know. What we don't know? Let us consider it as X. Naturally, when you don't know something, call it as X. So this is X, let us say. Sir, I am afraid of X. I cannot help it. You cannot be afraid of anything. You have to face things. So X, if it is the actual input, what will be the total actual input? That is 70 plus X. So actual quantity is nothing but total actual quantity will be total actual quantity is 70 plus X naturally. So what is RSQ? RSQ is nothing but the actual quantity distributed in standard mix. And what is standard mix? 50-50, which means equal. So what will be the RSQ for each of the materials? For A also, for B also. That will be what? 70 plus X divided by 2. For both of them. That is the total of actual quantity distributed in standard mix, which is 50-50, equal. So RSQ also we have. All that we need to do is substitute for each of the materials. So let us substitute for A and B separately. First one by one. So what is the standard price of A? The standard price of A is 12 rupees. Okay, fine. 12 rupees into RSQ of A is same, 70 plus X by 2. So let us call this as 35 plus 0.5x. That is easy every time. 70 plus X by 2 is that only. 35 plus 0.5x. That is RSQ of A. Minus AQ of A. How much? We don't know. That's what we took it as X. No? That is AQ of A. So that is the mix variance of A. Plus, this is all the mix variance of A. Plus the mix variance of B. So what is the standard price of B? 15. Then what is the RSQ of B? Once again same. 35 plus 0.5x. That is RSQ of B. Minus AQ of B we already know. Actual input for B is 70. So take that. That's all. That is equal to minus 45. So naturally, if you expand this, we'll get how much is x. Okay. So let us do that. 35 into 12, 420 minus 6x plus 525 plus 7.5x 15 by 2 and then minus 70 into 15 double naturally, that is 1050, that is minus 45. So take all of them at one place. 7.5x minus 6x, that is 1.5x is equal to 1050 goes to other side, becomes positive, minus 45 minus 420, because 420 becomes also negative, minus 525. That means 1.5x is equal to 60. So naturally x will be how much? 60 divided by 1.5, that is 40. And what was x? What we took as x first of all? What was x? That is the actual quantity of A. That we got now, 40. So what else we want? We have everything. We have standard price of both A and B. We have actual price of both A and B. We have standard quantity of both A and B, 50-50. Actual quantity of A and B, 40-70. Every variance you can calculate whatever is there. So that's what is question number 4. And that is how we got this standard quantity of B and actual quantity of A. Once we have this, finding out the variances is again straightforward job. So you do that one. That is question number 4. Again, question number 5 is relatively a straightforward question. There is nothing special there. Straight away, direct formula, substitute and get the answer. But only point is standard hours while you calculate. While calculating the standard hours, you have to take 30 weeks. But while calculating actual hours, you have to take 32 weeks. Naturally. So that is the only point to be noted there, which is already there clear in the question. So I hope all of you got correct answers in that question number 5. Then question number 6 also, there were some doubts. Here it is clearly given that the standard overhead absorption rate per hour is 3 rupees. So per hour, the standard overhead absorption rate is 3 rupees. Standard overhead absorption rate per unit is 18 rupees. So we have to understand that means for each unit, how many hours it will take? If it has to be 18 rupees per unit and 3 rupees per hour, each unit takes how many hours as per the standard? 6 hours. That is to be first of all identified from the information itself. So each unit of production takes 6 hours of time. That is one thing which is clear. Then it is given about the budgeted production, which is 7,500 units, but actual production is 7,610 units. And actual overheads are given, out of which fixed overheads are already given. So we know the actual overheads which are fixed also and which are variable also. 45,360 are fixed. So remaining 1 lakh naturally out of this 145,360 will be variable. So total actual fixed and variable overheads is given. Actual hours is also given, 46,830. And overheads are on the basis of the following flexible budget. Why that is given? Because we have to calculate all overhead variances, means fixed overhead and variable overhead we have to calculate. But the problem is, when he gave this 3 rupees and 18 rupees, he only said overhead absorption rate. He never said fixed overheads or variable overheads. So that is our job to segregate. That is why this information is given. Our job is to segregate the fixed and variable portion, and I have given that already in the key, the hint. How to get variable overhead rate per unit? This formula. Difference in overheads at 2 levels divided by difference in production units, or difference in cost divided by difference in level of activity. That is the formula for calculating variable cost per unit. Same logic we have to apply. So when production is based on a flexible budget like this, difference in number of units is 750, difference in cost, how much you have to find out. So 1,26,000 minus 1,17,000 divided by 750 will give us a variable overhead cost of how much? 12 rupees per unit. This is per unit because these are units we're talking. 12 rupees per unit. So in this 18 rupees, now what we know? Variable overhead is 12 rupees per unit. So naturally the remaining will be 6 rupees, no? According to the standard overhead absorption rate. That was 18 rupees total. 12 rupees is variable, 6 rupees will be fixed. Quite common. And if you want to calculate another check also, you can do that. Difference in these two costs divided by difference in the number of units. So 1,44,000 minus 1,26,000 divided by 1,500. Still it is 12 rupees only. So variable overhead per unit will be constant, that is 12 rupees according to the flexible budget that is given. So you know that 12 rupees is the variable overhead portion within that 18 rupees and 6 rupees is fixed overhead portion within that 18 rupees. But this is per unit. But we are used to hours and all that, and hours are actual hours are also given. So 12 rupees per unit means how much will be per hour? Naturally 2 rupees, because each unit requires 6 hours. So what is the variable overhead? Standard rate of variable overhead. Variable overhead, that is 2 rupees per hour. How much is fixed overhead? Standard rate, same standard rate but fixed overheads, that is 1 rupee per hour. That first of all we should find out. It will not be given in the question directly. Remaining things we can just calculate from the available information. First let us take variable overheads. So variable overheads, actual variable overheads is already known, which is 1 lakh, because out of 145,360, if that 45,360 is fixed, 1 lakh will be variable. So this is already known, nothing new there. Then SRAH, actual hours are given 46,830. SR of variable overheads 2 rupees, already we know that. So 46,830 into 2. That's what is 46,830 into 2. That is SRAH, that is known. Then we need SRSH. What is SH? Again we have to always keep in mind. Standard hours required for actual output. So if 7,610 units are to be produced, each unit takes 6 hours. How many standard hours would be required for actual output? That is 45,660. Multiply with standard rate, that is 2 rupees. So here 7610 actual production multiplied with 6 hours into 2, that is SRSH. Once you have, you can find out variable overhead efficiency, expenditure and cost variance. That's all. Same way for fixed overheads. There is no RBH here because number of days is not given. So only fixed overheads will have what? SRSH, SRAH, SRBH and ARAH. ARAH is already given, that is 45,360, which is clear. Nothing special there. Then budgeted fixed overheads are how much? That is also another point to be noted. That is not given directly, but we should know that. How? Budgeted production is given 7,500 units. And what is the overhead rate, fixed overhead rate per unit? 6 rupees. So 7,500 into 6 will be how much? That is 45,000 rupees. That is the budgeted fixed overheads. Given that is also, but indirectly given. So that is budgeted fixed overheads. SRBH. Then SRAH. We know standard rate for fixed overheads, which is 1 rupee. And we know the actual number of hours, 46,830. So substitute that, 46,830 will come. Same way SRSH. SH we already calculated, but again you can calculate 7610 into 6 multiplied with standard rate for fixed overheads is 1 rupee per hour. So always the care has to be taken. What are we looking at? Are we looking at units or hours? We are looking at hours while actually finally substituting it. But we should understand, when budgeted production is given 7,500 units, multiply with the 6 rupees per unit, that is the fixed overhead rate per unit, that will be the budgeted fixed overhead. So whatever the information we are using, that doesn't matter. Ultimately whether the answer is coming or not, that matters. You should be able to naturally convert hours into units, units into hours. That is the core point in this question. So that is SR/SH, which is nothing but 7610 into 6 into 1 rupee, which is coming to 45,660. See, once we have all the things, you can find out all the fixed overhead variances, efficiency, capacity, volume, expenditure, and fixed overhead cost variances. That is question number 6. So key point here is this one. How to find out variable overhead rate per unit when a flexible budget is given. Difference in cost divided by difference in number of units. That gives us variable overhead cost per unit. When that is known, if we out of 18 rupees, 12 rupees is variable overheads, naturally 6 rupees is fixed overheads. So like that, remaining things can be sorted in question number 6. Then, question number 7 is a more or less a straightforward question. There is nothing very particular about it, though the requirements are little number-wise more. But yes, once again, we need to be reading the question very carefully. So what was the data given here is the actuals. Actuals are given, materials consumed and everything. This is all actuals, actual cost we can say. So accordingly, we have to find out different variances. So one by one, if you see material variances, first of all, AQAP is already given. That is 1,89,000. So nothing for us to be specially calculating it. It is already known. Then AQSP. AQ, actual quantity of material consumed is 3,600 units. That is materials consumed. And standard price is 50 rupees per unit. So 3,600 into 50. That gives us 1,80,000 rupees. Then SQSP. SP is already there, 50 rupees per unit. SQ means the standard quantity required for actual output. See, in order to manufacture 1 unit of output, the standard quantity of requirement of material is one unit. So for each unit of output, you need 1 unit of input. For 3,600 units of output, how many units of input is required? Naturally 3,600 only. So that is the standard quantity required for actual output. That is the one minute. Output during the period was 3,500. So 3,600 units was consumed materials. This is consumed materials, not output. So the output during the period was 3,500 units of finished product. So for 1 unit, if it requires 1 unit of materials, for 3,500 units of output, how many units of materials would be required? 3,500 units of materials will be required. So 3,500 is SQ. Multiplying with SP, which is already known 50 rupees, we get SQSP. Once we have that, you can find out variances. Same way for labor variances. So labor variances, here idle time is also asked, so that has to be also kept in mind very carefully. So we have to have SRSH, SR into actual hours worked, that is different. SR into actual hours paid, that is different. AR into actual hours paid, that is really what the labor cost is all about. So how much is the actual labor cost? That is really paid, that is known, that is 22,100. There is nothing for us to calculate. Already that is given. But even if we want to calculate also, there is another hint also that is given. Overall wage rate has become 3.25 per hour on an average. And how many hours are paid? Paid. 6,400 hours are worked. In addition to that, 400 hours are also paid for idle time. So total 6,800 hours are paid at the rate of 3.25. Naturally, that's what is 22,100. 6,800 multiplied with 3.25. So that can be cross-checked also, which is matching with the question. Then another point here is what is the standard rate? Standard rate is already given. That is 3 rupees per hour. So wherever SR is there, you can just substitute that. 3 rupees, 3 rupees, 3 rupees. SR is there. Then actual hours paid are how many? Actual hours paid 6,800. Just now we know that. So 6,800 into 3. That is SR into AHP. That is actual hours paid. Actual hours worked how many? Actual hours worked are only 6,400. So 6,400 into 3. That is SR into actual hours worked. Then standard hours required for actual output. Once again, the standard hours required for actual output we have to find out. We can find out in a simple way also. For example, here the labor cost per unit is given as 6 rupees and it is 3 rupees per hour. 6 rupees is per unit and 3 rupees per hour. That means we should understand each unit takes how many hours? 2 hours, naturally. So if each unit takes 2 hours, 3,500 units take how many hours? 7,000 hours. So what is the standard hours required for actual output? 3,500 into 2. That is 7,000 hours. SR is already there 3. So SRSH we have. And once we have that, all variances can be calculated. So labor cost variance totally is 1 minus 4 in this case. Labor rate variance is only about difference between standard rate and actual rate. In other words, difference between 3 rupees and 3.25 rupees. That is simply 0.25 into 6,800 hours. That is 1,700 rupees adverse. The labor efficiency is not about paid hours, hours worked. Rate is common, standard rate, that is 3 rupees. How many hours they should have taken, but how many hours they actually worked to complete the task. Difference is efficiency variance. That is positive, which is favorable, 1,800. Idle time variance is about standard rate into actual hours worked minus actual hours paid. Hours paid are naturally always more than hours worked, then only there is idle time. And that difference is always unfavorable variance. In this case is 1,200 rupees adverse. That is about labor variances. So we have to infer the information that is given. That is a key point in any costing problem. Any question where the information will be there, we have to take the right information what we want. That is material and labor variances. So same way, overhead variances can also be calculated. Overhead variances are again classified into 2 categories, variable and fixed. Sir, he is using the word expenses, not overheads. What we can do? We want overheads only. Don't expect like that. Variable expenses means variable overhead only. That only we are talking. So what is the standard rate of variable overheads? SR per unit here. Per unit. Be careful. Per unit is 20 rupees. And per unit it takes 2 hours we know. So naturally what is SR per hour? That will be 10 rupees. So that is why we have to convert one by one. So SR is 10 rupees per hour. SH we know already, that is standard hours required for actual output, which is 7,000 hours. So we have SRSH. Actual variable overheads, so we don't have to calculate anything. It is already given, that is 62,000. Difference is the variance, that's all. Only one variance is asked, cost variance, that is 8,000 rupees favorable. That is variable overheads variances. Fixed overheads variances, all are asked almost. So one by one we can find out what is SR. First SR can be found out like this, standard rate. Again 40 rupees is per unit. So if 40 rupees is per unit and each unit take 2 hours, so how much will be per hour? That will be 20 rupees. So what is the SR for fixed overheads? 20 rupees per hour. So that is SR. Wherever it is there, 20 rupees you can fix. SH we already know. SH you don't have to calculate every time. Actual output, which is always 7,000 hours. So SRSH we have. Same way SRAH. Actual hours worked we know already, that is 6,400 hours. That is also known. Standard rate 20 rupees, we already know that. SRBH, budgeted hours. This is a important point here once again. Standard rate is there, which is 20 rupees, that is okay. But budgeted hours are how many? This can be calculated also in 2 different ways, because it is given that directly 9,600 hours are budgeted. That is the budgeted hours. So that is about one of the points to be noted, 9,600 hours. Or otherwise also you can find out, because budgeted production was how much? Our standard capacity was 4,800 units, and we know each unit takes 2 hours. So naturally how many hours it should take? 9,600 hours. So 4,800 into 2 or 9,600, which is nothing but directly multiplied with standard rate, you know already, 20 rupees. That comes to 1,92,000. So that also we know. ARAH we don't have to do anything. That will be given in the question. That is 1,88,000, which is the actual fixed overheads incurred. That's all. We have everything. You can find out fixed overheads expenditure variance, fixed overheads volume variance, fixed overheads capacity variance, which is asked, and efficiency variance also is asked. Total fixed overhead cost variance is not asked, but even if you calculate that, we can get the fixed overheads total cost variance, which is 48,000 rupees adverse. That is 48,000 rupees adverse, we can say. So it is the mix of these two. 52,000 volume variance negative and expenditure variance 4,000 positive. 48,000 adverse is fixed overhead cost variance. Then total cost variance, how to get it? You have to add all of them. Like, what was the original? Material cost variance 14,000 adverse, labor cost variance 1100 adverse, variable overhead cost variance 8,000 favorable, and then fixed overheads total cost variance 48,000 adverse. Then total cost variance is 55,000 1100 rupees adverse. That's it. This is how the problems have to be solved. So most importantly here, when we have the questions like this, you need to infer whatever the information is given. You have to first understand what is the information. You need to read the question carefully. What is the standard cost? What is the actual cost? And standard and budgeted production, how much? So per unit, each of them are how much? Per hour, how much? So when you have per unit, you should be able to get per hour also. That conversion is what is very important in any question wherever that is required. So I think question number 6 and 7 both are having only that point of where converting the standard rate of variable or fixed overheads into the standard rate per hour. So what is given is per unit. We convert it to per hour. That's all. Of course, here the per hour also is given 3 rupees, which is now distributed into variable 2 and fixed 1. So information. It's all about information, identifying, matching, and then using it wherever required. So that is the way such questions have to be dealt with. Okay. So that is the question paper discussion, or the task discussion, we can say. Now, coming on to the other small part of variances, which though not here in the ICAI book, in the earlier exams it was given, some of them, the old syllabus actually, but not a new syllabus. But there was no specific information also whether these sales variances are part of the syllabus or not. So why to take risk? Let us just quickly, don't have to spend too much time on this, quickly go through how to find out sales variances and what is the difference between all the cost variances and sales variances. Difference is in the direction itself. In case of cost variances, if actual cost is more than the budgeted cost or standard cost, that is wrong, that is adverse. In case of sales, it is opposite naturally. So here, if the actual is more than the standard or budget, it is fantastic, that is positive. So what can we do here? Simply just change the direction, the way we calculate variances. We have been always calculating 1 minus 2, 2 minus 3, 3 minus 4, 1 minus 4. Here we have to do reverse. 2 minus 1, 3 minus 2, 3 minus 1, 4 minus 3, and 4 minus 1. And for simplicity purposes, you don't need to specially remember once again some more formulae. Whatever formula used for, or the denotions we used for material variances, they can be used here also. But only difference we have to be very clear is, here we are not talking about input, we are talking about output which is being sold. So SQSP, RSQSP, AQSP, AQAP, same things. Denotions are just same things what we are telling. But what do they denote? That will be different. SP is okay, same standard price per unit of what? Again, not input. We are talking sales here, output, finished goods. What is our price we are charging to customers? Our budgeted price. See, when it comes to sales variances, there is no difference between standard and budget. Both are same. But because we are used to these denotions already, we are continuing to use them. So SP means the standard price per unit. AP means the actual price per unit. Selling price we are talking, once again to be clear. AQ means the actual quantity of sales. SQ means the budgeted quantity of sales. Here there is no actual quantity required for our input and all that. Standard quantity required for actual output and all that. So this is not input we are talking. Budgeted sales actually. You can call it BQ also. But once again, since we are used to one type of denotion, let us continue that. But we should understand when it comes to sales, budget and standard both are same. So budgeted quantity of sales is what is SQ. RSQ is revised standard quantity. The way we calculate is once again still the same. There is no difference. We take SQ first into total of actual quantity divided by total of standard quantity. That's it. That gives us RSQ. And look at the variance names here carefully. 2 minus 1 is quantity variance, not 1 minus 2, reverse it is. And if it is positive, it is favorable. If it is negative, it is adverse. So that is why we are doing 2 minus 1. No, sir, I will do 1 minus 2. Then at least change the side. If you do 1 minus 2, then negative will be favorable, positive will be adverse. Why to get all this confusion? Just change the direction, that is easier. So instead of 1 minus 2, do 2 minus 1. That gives us quantity variance. 3 minus 2 gives us mix variance. 3 minus 1 gives us volume variance. 4 minus 3 gives us price variance. And 4 minus 1 gives us sales variance, that is the total sales value variance. That is about sales variances. These variances names and formula have to be remembered. Nothing new here since we already used the similar denotions in material variances. But only point to be very careful here is we are not talking about inputs, we are talking about the output which is sold. So that is our product and the selling prices and all what we are charging to our customers, not the other way around. So this is sales variances in a nutshell. And there is one more small variation here, that is sales margin variances or profit variances, you can call them also. Sales margin is nothing but profit, right? So just keep all the other things the same. SQ, SP, RSQ, SP, AQ, SP, AQ, AP. But instead of SP and AP, call it SR and AR. That is easier. SR means the standard rate. Rate of what? Margin. Profit margin. Standard how much? Per unit. That is SR. How to get that? Budgeted selling price minus standard cost per unit. So standard cost per unit normally will be already there, as we have discussed in many questions. Budgeted selling price will already be there. The company will have its own estimate of the selling price. So budgeted selling price minus of standard cost per unit gives us standard rate of profit margin per unit. AR is actual margin per unit. So this is the only place where you have to be careful. Actual margin per unit, we may think that actual selling price minus actual cost. No. Here actual cost is not going to be taken. What is actual margin going to be taken as here in this case is actual selling price, okay, minus standard cost per unit only still. So we are not going to take the actual cost. So the margin variances and sales variances are not going to be worried about the efficiency of the enterprise. They are only going to be worried about the sales capacity or marketing capability of the enterprise. So that is why the actual cost is immaterial. Only we are going to take standard cost only. Actual selling price matters because that is what the ability of our marketing people who could sell at a higher price or not. So actual selling price is taken minus, instead of taking actual cost, we have to take standard cost. So remember, this part is very important when we calculate sales margin variances. Remaining things are same. AQ means actual quantity of sales. SQ means budgeted quantity of sales. RSQ means revised standard quantity or revised budgeted quantity, whatever you can call it. How you calculate RSQ? Same way. SQ into total of actual quantity divided by total of standard quantity. Names of the variances are also same. But instead of calling sales variance, we call it sales margin variances. So sales margin quantity variance 2 minus 1. Sales margin mix variance 3 minus 2. Sales margin volume variance 3 minus 1. Sales margin price variance 4 minus 3 reverse. And sales margin value variance, or we can just call it total sales margin variance, or we can call it total profit variance, that is 4 minus 1. These are sales and sales margin variances, very similar to the material variances, but we are not talking about inputs, we are talking about output. And another important point to note in sales margin variances is standard margin is okay, that is budgeted selling price minus standard cost, but actual margin, actual rate of margin is actual selling price minus standard cost per unit. That has to be taken as AR. So these are the formulae for sales variances and sales margin variances, which are quite possible to be asked as a surprise, not necessarily regularly, but if it is asked, we should not be in a position to lose that. That is why, just as a continuation of other variances, we can have these variances also. And let us quickly go through one problem. In fact, only one problem that is available as far as ICA's books are concerned, which is this. That too has only sales variances, and we can also calculate sales margin variances if you know the standard cost per unit. So we'll calculate both sales variances and sales margin variances from this information that is given in this question. What is asked is sales variances. Once again, as I said, budget and standard both are same when it comes to sales. All that you need to do is substitution, nothing much. So P, Q, or S. So P, Q, or S. Wherever SP is there, SP or standard price or budgeted price, both are same. So we are calculating sales variances first, then we'll come to sales margin variances. First sales variances. So SQ, SP. First let us fill SP wherever it is, standard price for each unit of output that we are selling. We are selling price, we can call it. It is given already. So 25, 50, 75 and 100. That's it. Wherever SP is there, this can be just copied. Then AP, actual price. Really we were able to sell at 30, 45, 70 and 105. This is AP. That's it. And AQ is given already. AQ is given as what? 4,800 for product P, 2,800 for product Q, 2,400 for product R, and 800 for product S. That is about AQ, AP or actual sales, we can say. Actual sales, really speaking. So total of that anyway can be found out. That comes to 5,22,000. Fine. Then AQSP also, here we can have the same thing, whatever is already done here. 4,800 AQ for product P, 2,800 for product Q, 2,400 for product R, and 800 for product S. That's all. So this is AQSP. Then budgeted quantity is already known. There is nothing for us to calculate here. All substitution, multiplication, nothing great. So 4,000 is the budgeted quantity. Then we have 3,000. Then we have 2,000. Then 1,000. So that is a budgeted sales we can call, which was 5 lakhs. Then RSQ is one thing we have to definitely calculate. What is RSQ? That is SQ multiplied with the total of actual quantity divided by total of standard quantity or budgeted quantity. So what is the total of actual quantity? First you find that 4,800 plus 2,800 plus 2,400 plus 800. That comes to 10,800. 10,800 is the total of actual quantity. And how much is the budgeted quantity? 10,000. So what is RSQ here? RSQ is what? Standard quantity, which is 4,000 into 10,800 divided by 10,000. 10,800 divided by 10,000. So that is RSQ SP. So only RSQ, if you want to calculate, you can do that separately also. SQ into total of actual quantity divided by total of budgeted quantity, which is 10,800 divided by 10,000, 1.08 you can say. So that is RSQ multiplied with standard price of 25. Like this we can do for others also. What was SQ for the Q product? 3,000 multiplied with 1.08 multiplied with 50. Same way. 2,000 multiplied with 1.08 multiplied with 75. Same way. 1,000 standard quantity multiplied with 1.08 into standard price 100. That's all. So that is RSQ SP. We have everything now. So all that we need to do is calculate sales variances one by one. So what are the sales variances here? one by one. 2 minus 1 is quantity variance. 3 minus 2 is mix variance. 3 minus 1 is volume variance. 4 minus 3 is price variance. 4 minus 1 is total sales variance. So each of them can be calculated. So quantity, mix, volume, price, value. So let us just quickly calculate them also. So quantity variance, we are getting numbers here. 2 minus 1. This is quantity variance, positive. Mix variance. Mix variance is negative, adverse. Volume variance naturally will be the sum total of these two. 3 minus 1, 20,000 positive. Price variance, 2,000 positive. Total sales value variance, 22,000 positive. That is favorable variance here for sales value. That's it. That is how we can find out sales variances from the data that is given. Now, we can do the same thing with the sales margin variances also, but just we'll take sales margin carefully. So what is sales margin variances? SQ, RSQ, everything will be same. AQ will be same. What will change is standard margin. Instead of standard price, we call it standard margin or standard rate. Let us call it standard margin. Standard margin. Standard margin. And here it is actual margin. So we are changing it. So how much is standard margin? How much is actual margin? That we can find out for each of the products. So how much is the standard margin? How much is the actual margin for each of the products we can find out. So standard margin formula is what? That was the budgeted selling price minus budgeted cost or standard cost. So budgeted selling price is 25, right? Minus standard cost. That is 5 rupees standard margin. Once again, 50 minus 40. 75 minus 60. 100 minus 90. This is standard margin. Actual margin. Actual selling price per unit. 30 minus standard cost only once again. So 30 minus 20. 45 minus 40. 70 minus 60. Then 105 minus 90. This is actual margin. So once you have standard margin and actual margin, substitute them here in the area where we are supposed to calculate these things. So substitute them here in the profit margin variances or sales margin variances. So SQ is already there. So that is standard quantity. Standard margin is different now. It is only 5 rupees. Then 10 rupees. Then 15 rupees. Then 10 rupees. That's it. That is SQ, SM. RSQ is already there once again. So here margin only changes. 5 rupees, 10 rupees, 15 rupees, 10 rupees. Same here also. 5 rupees, 10 rupees, 15 rupees, 10 rupees. Standard margin multiplied with SQ, RSQ and AQ. Actual margin. Actual margin is 10, 5, 10, 15. That's all. We have everything now. So we can find out sales margin variances also same like this. Sales margin quantity variance, sales margin mix variance, volume, price and value, everything can be found out like that. So how much is the sales margin quantity variance? 7,200 favorable. Mix variance 1,200 adverse. Volume variance 6,000 favorable. Price variance 2,000 favorable. Total sales margin variance, value variance, that is 8,000 rupees favorable. That is sales margin variances. And sales variances from the data, we just need to substitute in the format that we know and get the answers. Nothing very special about them. But yes, we have to be ready with that. We cannot completely neglect it just because it is not there in the ICA material. Suddenly, as a surprise, if it is given, we should not be surprised. We should be able to solve those questions related to sales variance and sales margin variances also. That's it. With that, we can conclude the standard costing chapter with all different types of variances, computation of them, understanding and interpretation of them we have discussed. And theory questions in the ICA material, I hope we have gone through them. And you should write some small short notes from those theory questions always as a habit. That will be helpful in the exams for attempting theory questions in the worst case scenario. But as far as problem solving is concerned, we have extensively covered all the possible questions, all possible types of models at this level. And there will be a lot of other questions at final level also, don't worry. That will come once again later. But as of now, at the intermediate level, these are well enough number of questions that we have practiced. And you remember the formula and practice the questions again and again so that you be thorough with this chapter. Each chapter in costing, the good news is once a chapter we are completing the discussion of and becoming comfortable with solving the questions of each chapter, automatically there are certain number of marks that are coming and joining into our pockets. So standard costing 5 marks minimum, 10 marks possible. Definite questions will be expected from this chapter. So practice them well, right? Fine, then we conclude the standard costing chapter with that, and in the next future sessions we'll discuss about some other topics. Till then, take care. Bye bye. Thank you very much.